The recent collapse of the US mortgage market is a troubling sign for the housing sector in 2024. It indicates that home prices may need to decrease, and unfortunately, many people in the real estate industry might face job layoffs. This downturn in the mortgage market is significant and deserves attention. According to a recent report from the Mortgage Bankers Association, the Mortgage Purchase Application Index has plummeted by 19% compared to a year ago. This decline means that potential home buyers are applying for mortgages at the lowest rate in almost 30 years. The average monthly purchase index now stands at 156, down 40% from pre-pandemic levels and lower than during the 2008 crash. In fact, current mortgage demand is at the same level as the mid-1990s. These historically low levels of mortgage purchase applications suggest that the upcoming spring housing market could be very quiet. With few home buyers closing on homes, there could be downward pressure on home prices in the near future. In states where home prices are already showing downward momentum, there's growing concern about the housing market's direction. Despite years of speculation about a housing crash, meaningful declines in home prices have only occurred in a few markets so far. Now, what could potentially ignite a broader decline in prices? On one side, we have a significant drop in mortgage applications, indicating reduced buyer demand for the upcoming spring market. On the other side, there's an increase in mortgage defaults among existing homeowners. This uptick in defaults could lead to more inventory hitting the market and potentially force selling, adding further pressure on home prices this year. The Mortgage Bankers Association's report highlights a concerning trend in mortgage delinquencies, particularly in the fourth quarter of 2023. The overall delinquency rate for mortgage loans on residential properties increased to 3.88%. While still relatively low compared to historical averages, there has been an acceleration in new loans entering delinquency, with some loans moving into later stages of delinquency. One particular concern is the significant increase in delinquencies on FHA loans, with the delinquency rate now at 11%, well above its pre-pandemic level. This is troubling as FHA loans often cater to first-time home buyers who typically put down a small down payment of around 3%. The rise in FHA loan delinquencies suggests that more first-time home buyers could be heading into foreclosure over the coming year. What's even more worrying is that alongside the increase in mortgage delinquencies, there has also been an uptick in credit card defaults. This simultaneous rise in both mortgage and credit card defaults is a cause for concern and indicates potential financial strain among households. It suggests that the consumer's financial health is deteriorating, with some even reaching breaking point. Credit card delinquencies surged in 2023, signaling significant financial stress among consumers. According to the New York Federal Reserve, credit card delinquencies increased by more than 50% as consumer debt ballooned to $17.5 trillion. Of particular concern is a graph titled Transition into 30-Day Delinquency by Loan Type. This graph shows a notable spike in transition into 30-day delinquency for credit cards, surpassing pre-pandemic levels by a significant margin. These trends underscore the challenges many consumers are facing, highlighting the need for careful monitoring and potential interventions to support financial stability. The surge in auto loan delinquency rates, now slightly above pre-pandemic levels, adds to the concerning trend alongside the increase in mortgage delinquencies. While the pace of mortgage delinquencies is slower, they are approaching pre-pandemic levels. This indicates a broad increase in delinquency rates across various types of loans, except for student loans, which are expected to see a rise in 2024 as forbearance periods expire. This isn't meant to incite fear, but rather to highlight the financial challenges facing US consumers and homeowners. Many are struggling to keep up with their bills, underscoring the need for support and interventions to help alleviate financial strain. When you observe the trifecta of increasing defaults in credit cards, auto loans, and mortgages, it signals that something significant is occurring in the background, something concerning. This trend is likely to result in more housing inventory hitting the market in 2024. This increase in housing inventory has been the missing piece from the housing downturn for potential home buyers, as it hasn't been sufficient nationwide to drive the type of home price declines necessary to make housing more affordable. 2024 could be the year where we finally see this shift happen. It comes at a time when demand to buy homes remains at rock-bottom levels and is unlikely to improve significantly. This convergence of factors suggests that the housing market could face significant challenges ahead. The lack of affordability in the housing market is a pressing issue right now. Even in markets where prices have begun to decline, it remains incredibly challenging for buyers to navigate the current market conditions. This underscores the widespread difficulty many individuals and families face in finding affordable housing options. The real issue in the housing market, and more broadly, is actually the home prices, not just the mortgage rates. While a 7% mortgage rate may seem high compared to a few years ago, it's actually within a normal range when considering the 30 to 40-year trend. What's different today is that home prices have skyrocketed, with inflation-adjusted prices still near their highest levels on record. Looking at 130 years of data on home prices in America, adjusted for inflation, we can see a clear trend. From 1890 to the late 1990s, home prices remained relatively stable, adjusting for inflation. However, starting in the late 90s and into the mid-2000s, we experienced a housing bubble, followed by a crash. Now, we're in bubble number 2, which has begun to deflate but remains excessively expensive. This graph illustrates the problem in the housing market. It's the prices. Many of you intuitively understand this point. It's not just the mortgage rate that's the issue. It's the soaring home prices that make home ownership increasingly unattainable for many. It's indeed a challenging reality that many in the housing market are still grappling with. There's a prevailing sentiment among industry professionals, whether they're realtors, mortgage brokers, or real estate investors, that there might be a quick turnaround, a swift resolution to the current market dynamics. However, unfortunately, that doesn't seem to be the case. We're witnessing widespread layoffs occurring in the real estate industry, a trend that began in late 2022 and has persisted into 2023. For example, Country Club Mortgage, a mortgage originator in California, recently laid off all its employees, including the CEO, and closed all its offices, affecting 105 staffers throughout the state. Similarly, Atlanta-based Crescent Mortgage Company is also shutting down, resulting in layoffs for all its employees. Realtors are also feeling the impact, with a significant decline in membership reported by the National Association of Realtors. They've lost 32,000 realtors, a decrease of 2.1% from a year ago. This trend is expected to continue, with further declines anticipated over the next 24 months based on past housing cycles. These developments underscore the severity of the challenges facing the housing market and the broader real estate industry. The prediction is that realtors will continue to drop out of the market over the next 2 years, and significant price drops are needed for transaction volume to recover and for real estate professionals to regain profitability. To understand where home prices might drop the most over the next year, a home price forecast score has been developed. This score utilizes 5 different data inputs to project and predict the future direction of home prices over the next 12 months in every state, county, metro, and zip code in America. For home buyers and investors, especially those still looking to buy in the current market, paying attention to this data is crucial as it offers valuable insights into where the market could be heading in the coming year. The score ranges from 0 to 100, with lower scores indicating a higher likelihood of prices decreasing. Texas, with a score of 42, has the lowest score in America, indicating downward price pressure. Texas has transitioned into a buyer's market due to increases in inventory, more price cuts, and lower home price appreciation. However, it's essential to note that there are significant differences within Texas in terms of how much home prices might decline and the likelihood of decline over the next year. This emphasizes the importance of examining data specific to one's state, metro area, and zip code, as real estate markets vary significantly by neighborhood. While broader trends may impact a metropolitan area, conditions within neighborhoods can differ greatly. In Dallas, we observe a mix of home price scores across different neighborhoods. In the north side of town, zip codes show positive scores, such as 59 and 57, indicating upward price momentum. However, in areas south of Dallas, scores are notably lower, ranging from 27 to 29, suggesting downward price pressure. For prospective buyers, understanding these data points specific to their neighborhood is crucial. Without this information, buyers risk navigating the market blindly, solely relying on the guidance of realtors without a clear understanding of local market dynamics. Relying solely on news headlines or generalized market trends reported by media outlets like CNBC may not provide the nuanced understanding needed to make informed decisions. It's essential to delve into the underlying data to grasp the true dynamics of the local housing market. Taking Florida as an example, we can see variations in home price scores across different areas. In places like Lakeland, where the score is 38, indicating downward price pressure, and Pintor, with a score of 32, there's evidence of declining prices. It's crucial for prospective buyers in Florida to examine these specific data points to understand the state of their local market accurately. Similar trends can be observed in other regions, such as mountain areas and certain parts of California, where downward price pressure persists. By analyzing localized data, individuals can gain a clearer picture of market conditions and make more informed decisions about buying or investing in real estate. Analyzing the Southern California housing market, we can see significant disparities between areas like Los Angeles and Anaheim or Orange County. While some parts of Los Angeles exhibit downward price pressure, certain zip codes in Orange County show upward momentum in prices. For instance, zip code 92618 in Orange County indicates signs of upward price movement, including recent appreciation, shorter days on the market, and inventory levels suggesting a buyer's market. This situation presents a dilemma for prospective buyers. Should they enter a market with rising prices or wait for potential price declines? To make an informed decision, individuals can utilize platforms like Reventure to access comprehensive home price forecast data for their specific area. By understanding historical trends and the various components of the scores, buyers can gain valuable insights into their local housing market dynamics.